Welcome to the deep dive. If you've been watching the charts, well, the last few weeks felt pretty seismic. Today, we're on a critical mission, really digging into what our sources are all calling the Great Reset in the crypto market. It was painful, volatile, yeah, and it exposed some pretty fundamental weak spots. We need to figure out what exactly broke and, maybe more importantly, how long until things might stabilize.
Yeah, the scale here it's massive. You really can't overstate it. The data we've looked at confirms this was, quote, the biggest leverage flush since 2024. And maybe even when you look at the sheer capital involved, potentially the largest liquidation event in crypto history, we're talking about a huge reset of how the market was positioned.
Okay, that sets the stage perfectly. We're not here just to talk about the fear and doubt, the FUD, though there's plenty of that. We want to cut through that noise, get straight to the technical mechanics of the crash, understand why the system was so fragile, and look at what the analysts are saying about recovery, because they don't all agree.
So let's start right at the core. The specific trade that blew up, right? So leverage is obviously the big accelerant here, but the specific trigger, the fuel, was this massive, really crowded trade. It was built around this gold BTC catch-up narrative. You had gold showing incredible strength globally, geopolitical stuff, central banks buying, and traders just assumed Bitcoin, digital gold, would have to follow.
So everyone piled in long, basically betting Bitcoin had to catch up to gold's run. And that assumption, that crowded trade, became the weak point when things got choppy.
Exactly. The moment volatility really spiked, that trade just collapsed instantly. And when that happens in a crowded space, the forced liquidations just cascade. And here's the really crucial technical point. Liquidity just vanished right when everyone needed it. It created this vacuum. Selling just meant more selling.
And the number that keeps coming up in the data open interest across Bitcoin and the alts just sliced in half, that's huge. It's more than just lost money. It's a structural warning sign, isn't it? Our sources are calling it a serious reality check on how fragile liquidity really is.
It was a flush out, definitely. A violent one, maybe, but a flush out. So the market's now basically in reset mode. That excess leverage, gone. And this forces everyone funds, traders, to completely rethink things. No more high risk, high beta plays for a bit, which is why you're hearing analysts call this period chop season.
Okay, chop season. So for you listening, what does that practically mean? If we're in this phase, what kind of trading works or maybe what doesn't work anymore?
Well, chop season basically means long-range trend following. Probably not going to work well. Liquidity is thin. Those big institutional buyers are kind of sitting on the sidelines for now. So you should expect tighter ranges, smaller moves, maybe quicker, whippier price action. Strategies that rely on those smooth high momentum breakouts, they're likely to get chopped up. The market's probably going to reward shorter-term trades, think mean reversion, trading the range, that sort of thing, at least until we see some real new demand step in, which, as we'll get to, is kind of the big question mark right now.
Right, so the market's resetting. But that fragility, that liquidity disappearing act we just talked about, that's obviously shaking confidence badly. And it seems like a lot of that FUD is now pointing directly at centralized players, specifically Binance. We're seeing those FTX comparisons everywhere.
Yeah, and that's where the fear really starts to compound, right? Because it's not just about leverage washing out. This introduces actual counterparty risk. Systemic risk. The rumors flying around are pretty potent. You're hearing things like possible FBI domain seizures, funds being frozen, withdrawals halted. Whether they're true or not, just the rumor is enough to drive behavior to accelerate those outflows.
But it goes deeper than just rumors, doesn't it? The specific blame being aimed at Binance, according to some reports, is that the cascade itself, this reported over $100 billion liquidation event, was made worse, maybe even triggered by technical issues on the exchange, specifically faulty internal price oracles.
It's a pretty staggering claim. The allegation is that these faulty oracles caused some tokens to lose their peg, but only on Binance. That created artificial price swings, which then triggered the liquidations, wiping out huge players, whales, funds, who thought they were safe, collateral-wise. If that's actually true, it means a centralized system's tech failure was the direct catalyst, not just, a macro headwind blowing things over. Wow. That really raises some uncomfortable questions about where the real risks lie in this system. So what was the actual measurable impact, the fallout from this loss of confidence? Well, you measure it in cold, hard cash leaving the cutting. Billions have flowed out of centralized exchanges just the last week or so. And Binance alone, according to the data, saw something like $23 billion in outflows. That's verifiable. So the advice you're seeing cited everywhere is pretty blunt, pretty direct. Remove funds and sit out for a while. You just can't ignore that level of capital flight. It tells a story.
Okay, I get the fear, but connecting this back to the bigger picture, it's interesting that the expert consensus seems to be that the overall macro structure, the big economic story, hasn't broken.
Right. And that's maybe the key difference between this and, say, a true prolonged bear market. That broader rate cut cycle everyone expects globally still seems to be on the table. Gold is still strong. The very thing traders were betting Bitcoin would follow. So structurally, yeah, this looks more like a reset than a trend reversal. The underlying economic narrative supporting crypto hasn't vanished. The system just got a really harsh, maybe necessary clean out.
But that clean out has a cost, and that cost seems to be time. The analysis suggests this whole event pushed market momentum back by months, and the institutional buyers, the ones who bring the big, steady money, they've gone quiet.
Exactly. The market's kind of holding its breath, waiting for that next big source of demand to show up. You have to remember, back in the first half of 2024, the buying pressure, the bid, mostly came from two places: MSTR, MicroStrategy, and debt inflows, which are various institutional funds, ETFs, etc.
Ah, right. So those were the consistent heavy hitters keeping prices supported.
They were the floor, essentially.
Yeah.
But those flows, they've cooled right off. And general spot ETF inflows have slowed too. So the market needs a new, reliable source of large-scale buying to really kickstart a proper recovery. And right now, well, it's TBD, to be determined. And that uncertainty, it's created this real split among top analysts about what the recovery actually looks like from here.
Okay, let's dive into that disagreement. Starting with Benjamin Cowan, his take sounds, well, pretty cautious, especially for altcoins.
Yeah, Cowan's caution is almost entirely focused on central bank policy.
Yeah.
Specifically, quantitative tightening, or QT. Just quickly for listeners, QT is when central banks shrink their balance sheets. They're actively pulling liquidity out of the system.
So they're basically draining the swimming pool the market needs.
Exactly. And Cowan's point is that, historically, altcoins only really start to perform well after QT ends. He points to 2019 as the key example. Now, Jerome Powell has hinted that this balance sheet shrinking might stop soon, but until it actually stops, Cowan basically says holding Bitcoin is the safer bet, much safer.
And he lays out two pretty distinct paths for Bitcoin, which seem like they determine everything else. What are those scenarios?
Okay, scenario one is the optimistic one. Bitcoin breaks out relatively quickly, makes new all-time highs. If that happens, yeah, altcoin pairs might finally get a bounce. But even then, Cowan thinks a real alt season probably wouldn't kick off until late 2025. Scenario two, the more worrying one, is if Bitcoin doesn't hold these levels and drops down to the 50-week simple moving average, SMA.
Right, and just to clarify, that 50-week SMA is a big technical level. It's a long-term trend indicator. Hitting that would signal some serious weakness technically.
Correct. And Cowan warns, if Bitcoin does drop to that 50-week SMA, altcoins could crash 40 to 50% harder than Bitcoin itself. So his view is kind of Bitcoin is your shield, your relative safe haven, whether the market goes up or down in the near term.
That paints a very patient, risk-off kind of picture.
Okay, but then let's switch gears to Lark Davis. His outlook sounds much more bullish, much faster on the recovery. But wait, if institutional trusts got hammered because of these alleged Oracle failures on a major exchange, wouldn't that make Cowan's slow path more likely? Why bet on a quick recovery this time?
That's a really good question, and it gets to the heart of the debate. Davis sees the shock, absolutely, but he views it more as a necessary leverage purge. Painful, yes, but short-term. Not something that fundamentally breaks the cycle. He compares the scale $880 billion wiped out, 21% of the market cap, to past big liquidations. Think May 2021 or the FTX collapse. And in those cases, he points out, the market recovered its previous highs typically within 1.5 to 3 months.
Okay, so he sees the scale of the liquidation not as a death knell, but just as a really fast, violent clearing out. What's his core argument for why recovery should be quick this time? Why are we still in a bull market, according to him?
Davis argues we're in a fundamentally different kind of cycle now. A longer, macro-driven cycle, not the old 4-year crypto-native halving cycle that usually led to deep bear markets. This longer cycle, he believes, is supported by global trends, expected rate cuts eventually, rising global liquidity overall. That favorable backdrop means risk assets like crypto should bounce back faster even after a shock like this caused by, centralized failures.
That makes sense. If there's more money sloshing around globally, it has to go somewhere. So what's the key metric he's watching? How does he validate this idea of a rapid, extended cycle?
His main focus is on the total crypto market capitalization. He's pinpointed a specific level, $4.13 trillion. If the total market cap reclaims that $4.13 trillion level within the next 90 days or so, Davis sees that as confirmation, proof that we're still in this extended bull cycle. Hitting that would, in his view, set the stage for a really strong run into 2026. If we don't reclaim it soon,
Oh, well.
Cowen's cautious view starts looking more likely.
Okay, before we wrap up, it feels important to touch on what's still working. What sectors are showing life despite the chaos, and maybe the bigger picture adoption trends? Our sources highlighted perp-DEXs, decentralized perpetual exchanges, as one area holding up relatively well, which feels timely given all the concern about centralized exchanges like Binance.
It does feel timely, yeah. These platforms let you do leverage trading, but it's all on chain. No central custodian holding your funds. Platforms like Hyperliquid, HYPE, seem to handle the stress better than centralized ones, although, look, they weren't totally immune. Their open interest still dropped about 50%. But what's interesting is the competition coming. You've got Lighter and Aster launching soon. That should drive innovation, hopefully leading to even more robust, trustless ways to trade with leverage.
And stepping back even further, the long-term institutional view still seems really positive, looking way past this current mess.
Absolutely. The research we looked at points to the big players staying committed. You had BlackRock's Larry Fink saying recently that ETFs, that was just step one. He argues that tokenization, putting real-world things like stocks, bonds, real estate onto blockchains, that's the next huge wave of adoption. We're talking trillions of dollars in potential value there.
And we're already seeing that integration happen, not just in finance theory, but in actual tech infrastructure being built for payments and AI.
Right. Look at that Cloudflare partnership. They're working with Visa, MasterCard, Amex, the giants, to build secure systems so that AI agents can eventually shop and pay for things autonomously. That's foundational stuff being built now for a future where AI handles commerce using blockchain rails. So yeah, that long-term adoption story is still very much playing out.
And finally, it looks like regulators are already reacting to these failures. Japan is apparently drafting new laws specifically to outlaw insider trading in crypto. That signals tighter oversight is probably coming across the board. Okay, so let's try to synthesize this for you, the listener. What we seem to have is a market that's fundamentally okay from a macro perspective. The bigger economic story is still potentially favorable. Future adoption looks strong with big players involved. The UT confidence just got shattered by a massive leverage unwind made worse, allegedly, by failures at a major centralized player, Binance. So it leaves us in this kind of high-stakes waiting game. Will it be Cowen's slow, cautious recovery tied to central bank policy, or Davis's faster, macro-driven bounce back?
Exactly. And that leads us to the final, maybe provocative thought to leave you with. Given that this huge market reset, this cleanout, was apparently triggered or at least significantly worsened by faulty centralized systems, and given that the future growth narrative is all about tokenization and AI payments, which seem to demand more robust, transparent, decentralized infrastructure, does this massive reset actually accelerate the shift away from centralized giants like Binance towards more decentralized alternatives? Or will regulation just end up tightening the grip on the existing big players, forcing them to be more compliant, but keeping them dominant?
That feels like the core tension to watch over the next, say, 90 days. So for you listening, keep those key things we discussed in mind. Maybe do some reading on quantitative tightening, QT, and its effects. Watch that Bitcoin chart for the 50-week SMA. That's a key level now. And keep an eye on the total market cap. See if it can reclaim that crucial $4.13 trillion mark. The next chapter starts now. Thanks for diving deep with us today.